Well, hopefully people are beginning to figure out the stream. I can see there's one person on. People may be crying uncle. I don't know. We'll see. I'm just going to give it. Who's back on? If you don't mind, let me know. Oh, we're starting to get some more people. And I'm going to give it another minute here. So somebody just give me a thumbs up, or not a thumbs up, or whatever, emoji or whatever, saying, "Yep, we're good. We're streaming." Only 4. So can you guys? Is this working? Again, can anybody just let me know? I know there are 4. It looks like there are 4 viewers right now, but I just need to know that this is working before I start. Again, I'm hoping that get it figured out. So we're only down to 3 here. Let's see if it's... Alright, let me look at it this way. Alright, so it is working. Alright. I don't want to hear myself. I hate that. Alright, well, you know what? I know right now no one said anything, but it seems like it's working, so we're going to go ahead and proceed. We're up to 6. I know there were a lot more before, but that's okay. I know people will end up catching up. Again, if you do see this and want to let me know that you're back on, that's great. If not, we're just going to kind of keep marching because people can watch this later. Okay, so I know that I think it posted 11:45 is when this was going to start. So we're at 11:46. We're going to go ahead and start moving out. Let's see here. All right. So equity securities. So unlike debt securities, where assumptions kind of drove everything, here relative influence is going to drive everything. And so whatever the influence that the firm is exercising, that's going to determine how we account for the investment. And so how do we measure relative influence? It's measured by the percent of shares owned. Under US GAAP, that is the only way to measure relative influence. There is not flexibility in how you do it. And so it's by percent of shares owned. And so there are 3 levels of influence based on the percent of shares owned. The passive classification means that the firm owns less than 20% of the outstanding shares. In that case, we do use fair value accounting. Very similar to what we did with trading securities for debt investments. Very, very similar. The second classification is significant influence, and that's when the company owns 20 to 50% of the outstanding shares. There are no fair value adjustments in this case. Instead, we use what's called the equity method. And then finally, if you have more than 50% of the outstanding shares, that's considered control. And in that case, you're going to actually do a consolidation. Now with consolidations, that's like a whole other class in the MAC program. And so we're not going to cover consolidations in this class, but we are going to cover the first two categories, passive investments and investments where the company has significant influence. So those are the two we're going to cover. Let's talk about passive investments. They are reported at the fair value. Major characteristics: the initial price will remain what's called the cost basis of the equity investment. That's a term you need to get used to. So the cost basis basically is what did they pay for the investment initially, and it's going to stay on their books. And so for as long as the company holds that investment, it's going to stay on their books at its cost. So there's no amortization, nothing like that. It just stays at that number the entire time. If there is a dividend, that is called dividend revenue. So if there's a passive investment and a dividend is paid, that is going to be recorded as dividend revenue. With a passive investment, they make periodic fair value adjustments, and any unrealized holding gain or loss is going to be part of net income. So this is just like the trading security for the debt investments. And then finally, if it's sold, there's going to be a gain or a loss. So a company buys 1,000 shares of GE stock. Hopefully it's fairly clear that 1,000 shares of GE stock is much less than 20%, and so this is going to be a passive investment. They pay $35 per share. There's a dividend. There's an update in the fair value of the shares, and there's a sale. All kinds of things going on, and we're going to go ahead and record all of this. All right, so let's provide all the journal entries for these 2 years and any financial statement effects for the 2 years as well. So let's start with the first bit of information, which is the number of shares along with the dividend. So purchases are pretty straightforward. We have the share price multiplied by the number of shares acquired, which is 35,000. The dividend receipt, again, is 50 cents per share times the number of shares that we held at the time, which is $500. And hopefully the journal entries for this aren't too difficult, but the equity securities is $35,000. That's a debit. Of course, we paid cash for a $35,000 credit when we acquire the shares. And then the cash dividend, we receive $500 cash, and we record the dividend revenue of $500 as well. So again, I'm hoping these two first journal entries, fairly straightforward. Again, we debit the equity security, we credit the cash when we purchase, and then dividend revenue for a passive investment is a credit, and with cash, of course, we're going to debit because we're receiving cash with the dividend. So the second piece then is the update on the fair value at the end of the fiscal year. And so again, with the passive investment, we need to make fair value adjustments. And so how do we do that? Well, the fair value per share is given as $37. The cost per share was $35, which means there should be a fair value adjustment account balance of positive $2 per share. At the time of December 31st, 2020, we hold 1,000 shares, and so the entry amount needs to be a $2,000 debit. So again, there should be, there's no prior balance, and so the entry amount and the account balance are exactly the same. And so we're going to debit our fair value adjustment account $2,000. And again, similar to the trading security with the debt investment, it's the unrealized holding gain or loss is an income statement item, and so that we designate it dash income. So it is part of net income. It's a temporary account. It gets closed to retained earnings. So $2,000 debit to the fair value adjustment account and a $2,000 credit to the unrealized holding gain or loss dash income account. So then on February 5th, 2021, we sold 220 shares at $33 per share. So the cash that we receive is $33 per share times the 220 that we sold. The equity securities are $25 per share. Again, that was the original cost. We paid $25 per share going back. Actually, that should say $35 per share. I think I actually wrote down the wrong number. Let's see if my math was wrong too. Okay, so that just I just wrote down the wrong number. Let me switch that. Again, first time through. Bear with me. All right. So the equity securities, the cost of the equity securities was $35 per share. So that's the credit to the equity security account. And of course, we do have the fair value adjustment account that had a balance of $2 per share applied to the $220 per share, or shares. So the total of 440. The balance in our fair value adjustment account was a debit balance. And so when we make the sale, we need to credit that account to get rid of that balance. Now, there is no unrealized holding gain or loss account as part of this journal entry, because remember, that was a temporary equity account that got closed to retained earnings. And so the only thing left then is the gain or loss. And so with our journal entry, we receive $7,260 cash. The equity securities are credited for $7,700. The fair value adjustment account is credited for $440. And so in this case, we have a loss of $880 when we sell this security. Again, this is much simpler than the debt investment. Hopefully you're seeing that already. Much, much, much simpler. Again, if you have any questions, feel free to go ahead and in the chat ask your question, and I'll slow down. But I think we're probably doing okay. I don't want to move too fast, but. All right, so now GE declared and paid another 50-cent per share dividend on October 31st, 2021. The only wrinkle here is instead of having the full 1,000 shares, we only have 780 shares. And so the dividend receipt is $390. And so again, the cash is going to be debited for $390, and dividend revenue is going to be credited for $390. Hopefully that's not too bad. Again, 50 cents per share times 780 shares, debit to cash, credit to dividend revenue, because this is a passive investment. And on December 31st, 2021, the shares are trading at $38 per share. So again, because this is passive, we need to make the fair value adjustment. And so we're going to kind of walk through the fair value adjustment. The fair value is $38. The original cost was $35. Again, that hasn't changed. So the balance per share should be $3 per share. In this case, of course, there was a prior balance of positive $2 per share. So what that does mean? It means the entry amount is an increase of $1 per share times the 780 shares that we own, for a total of a $780 debit to the fair value adjustment account. So we debit the fair value adjustment account, and of course, along with that, we're going to credit the unrealized holding gain or loss - income account for the same $780. Again, same process that I've always used. Take the fair value, have the cost, and then look at the prior balance. Okay, so now let's provide all the financial statement effects for the 2 years. So first of all, the balance sheet for the equity securities are always at the original cost. And so on 12/31, there's 1,000 shares, but the difference on 12/31/2021 is that there are only 780 shares. And so the account balance is going to change because of the 220 shares that were sold. The balance sheet for the fair value adjustment account, again, we have to think about the balance that we calculated. And so the balance on 12/31/2020 is $2 per share, again 1,000 shares, for a total of $2,000. On 12/31/2021, the balance in the account is $3 per share, and at that time we hold 780 shares for a total account balance of $2,340. And so on the balance sheet, under the assets, we have the equity securities, and we would have the fair value adjustment account. So remember, the balance sheet is all about the balance. The equity securities are always at their original cost, and the fair value adjustment is the difference between the fair value and that original cost. Again, a lot fewer things to worry about when it comes to equity securities. So now let's talk about the income statement. Several things are going to show up on the income statement. We have the dividend revenue, we have gains and losses if we make a sale, and of course we have the unrealized holding gain or loss, knowing that in this case, because it's a passive investment, that unrealized holding gain or loss is part of net income. It's a temporary equity account. It's part of net income. So the dividend revenue, we just have those journal entries. It was $500 in 2020, and it was $390 in 2021. The unrealized holding gain or loss dash income account, again, it's the adjusting entry amount. It's the change in the account for the year. And so on 12/31/2020, the entry amount was $2,000. And on 12/31/2021, the entry amount was $780. And finally, we do have the gain or loss. In this, in case there was the loss on sale on 2/5/2021 for $880. And so all that information goes into our income statement. All of these items are non-operating items. So the dividend revenue, the loss on sale, and the unrealized holding gain or loss, those are all non-operating items. And we're just taking the information from above and throwing it into this table just for our ability to digest it. Again, hopefully after doing so much with the debt securities, this one's not too complicated. It's just a lot fewer things going on here. Again, I know I'm moving a little more quickly. I just feel like most of this is so similar, I don't want to spend too much time. All right, let's talk about the portfolio approach for equity securities. So just like the debt securities, you can use the portfolio approach for making fair value adjustments. And again, similar to what we had done before, rather than having a fair value adjustment for each individual security, you have a fair value adjustment account that applies to the entire portfolio. And so again, the difference then between the fair value of the portfolio and the cost of the portfolio, that becomes the fair value adjustment account balance. Again, no difference in the way that dividend revenue is recorded. It's just in the way that we handle the fair value adjustments. By the way, the other difference then is the fair value adjustment account is not security specific. So when there's a sale, there's no entry for the fair value adjustment account because again, it's not security specific, and so we don't have that as part of our journal entry. Again, we're going to go through an example, and you'll see that here in a second. So a company has a portfolio of equity investments whose original cost was $51,500. We're told the fair value as of December 31st. Then we have a sale of a portion of the portfolio along with the cost. And then we have a purchase. We have dividend revenue, all kinds of things going on here. So let's kind of walk through it. Let's provide all journal entries for 2021. So we're just going to focus on 2021. So on April 30th, or April 10th, they sold a portion of its portfolio. We have the cost. There's also the purchase, and we have some dividends. So let's kind of walk through each of these. So first of all, I have the sale of the securities, and so again, we're told that the cash was $19,200. We're told that the original cost was $15,000. And so the cash that we received was more than the original cost, and so there is a gain on sale. Again, highlighting here, because of our approach with the fair value adjustment account, the gain or loss is simply the difference between the cost and the cash that we receive. And so this is a gain on sale of $4,200. We also purchase securities, and we receive a dividend. So again, whenever we purchase securities, we receive we pay cash $42,000, and we debit the equity security account $42,000. And then, of course, with the dividend, we receive cash and we record dividend revenue. So I'm hoping that these things are largely the same. The only difference here is on April 10th, the fair value adjustment account is not going to be part of the journal entry whenever using the portfolio approach. Everything else is the same. All right, so now let's talk about the equity method. Oh, and by the way, I can't believe I forgot to do it. That's kind of frustrating. Let me make sure I didn't put it somewhere in the wrong place. Yeah, I didn't. All right, so with this portfolio approach, I would still have to do the fair value adjustment. I did not calculate that here. I don't know why I didn't. But what I'll do for those of you, I'm going to post something on Canvas. So I'm going to post the solution, the final bit of this solution on Canvas. So we're not going to go over it here, but I will post the solution. Got ahead of myself when I was creating these slides, and I forgot to do the fair value adjustment. But I will post that. So there still would be a fair value adjustment. I just forgot to record it, but I'll do it later this afternoon. So equity securities that are accounted for using the equity method. So now we're transitioning, instead of passive, we're into that significant influence category. So 20 to 50% of the outstanding shares. And so so equity securities that are using their equity method, it's going to report it at cost initially, and any changes to retained earnings. Now when you say changes to retained earnings, what we mean is that investment has a balance sheet. And if there are changes to that investment's retained earnings, that's going to create changes to our equity security account balance. And so when you're using the equity method, you have to pay attention to the retained earnings of that acquisition. So whatever shares we have, we got to be thinking about what is going on with the retained earnings related to those shares. And so that's really important. I think with the equity method, some students get confused, but if you can really think about the retained earnings, that will help keep you in focus. And so we'll kind of walk through what that means, but just I wanted to kind of lay this out here at the very beginning. All right, so what are some important concepts to be thinking about? First of all, the fair value of the securities really doesn't capture the value of the investment from the firm's perspective. And what I mean by that is the reason that I'm holding the shares is because I want to influence the company that I've acquired, or not, that I've now have shares of. I'm trying to influence them. And so whether the market price goes up or goes down, it's not necessarily relevant, because I own the shares in order to exercise influence, not to make some sort of short-term gain. And so the fair value becomes less relevant. And so this equity method allows for an approach to the accounting that ignores fair value, because the idea is that that's not relevant to this investment. So the firm plans to hold the shares in order to exert influence. And so the only thing that can create value is if the investee has a greater ability to pay a dividend. In other words, if I can keep my influence and now get more cash than I previously expected, well, that's important, because now they're paying me a dividend along with maintaining my influence. And so the value in the investment is created when the ability to pay a dividend increases. This is a very key concept. And so if I have this investment and they have a greater ability to pay a dividend, then that greater ability adds value to me. Whether or not they actually pay the dividend doesn't matter. It's just that they have the ability to pay a dividend, because that increases the value of my investment. I get to keep my influence, and now I have a greater expectation of future cash flows. And so that's the whole idea of what creates value. It's the only thing that creates value with the equity method is the ability to pay a dividend. And so the ability to pay a dividend increases with greater retained earnings. So as retained earnings goes up, the ability to pay a dividend goes up, the value of the investment goes up. So the investor retains the influence, but now has a right to future dividends. So therefore, the value of the equity security changes when the investee's retained earnings change. So you got to think about the investee's retained earnings. The equity security account balance is going to change when the investee's retained earnings change. We have to think about that. So keep that connection in mind. So be thinking about investees' retained earnings and think about your equity security account balance. Those two things go hand in hand. So if the investee has net income, that's going to be an increase in the value of the equity securities. If the investee has a loss, that's going to be a decrease in the value of the equity securities. Because again, you pay dividends out of retained earnings. So if retained earnings go up through income, that's good. If the retained earnings go down because of a loss, that's bad. This is the one that's usually harder for students to understand. When the investee pays a dividend, what happens to retained earnings? Well, the retained earnings are decreased. Remember, whenever a dividend is declared, right? Whenever you declare a dividend, remember, you debit your retained earnings, going all the way back to chapter 15. And so the investee, whenever they declare a dividend, the value of their retained earnings goes down. Well, remember, from this perspective, that means the value of my equity security goes down as well. And so whenever the investee pays or declares a dividend, that's when the value of the equity security is going to go down. But remember, now I have cash. So if you pay me cash, all I'm doing is trading off one type of asset for another. I get cash, that's a debit. But of course, the value of my equity security goes down, that's a credit. So they just offset each other. You're just changing the form of the value. Again, an example probably is going to help, but this is just a slide. I always suggest as you study, this is a slide you should continue to go back to and try to fully understand. All right, so we have 100,000 shares out of 400,000 of its suppliers. They place its CEO on the board, exercise influence, all that stuff, making it clear this is an equity method type of problem. They paid $40 per share. I give you information about the fair value, but I want you to understand that $43 is there, but it's irrelevant. And so we got to think about what's going to affect the retained earnings. That's the key. All right, so let's record the purchase. Hopefully that's easy. $40 per share times 100,000 shares is $4 million. So we're going to debit our equity investment $4 million, and we're going to credit cash $4 million. Hopefully that's easy. So let's record the December 31st journal entry. So the investor has a right to the investee's retained earnings. All right, so the investor's proportional right to the investee's retained earnings changes the value of the investment. So again, as the retained earnings change, the value of the investment changes. So what changed? Well, the investee had net income. So the total net income was $165,000. As a 25% shareholder, I'm entitled to 1/4 of those retained earnings. And so the value of my investment goes up 25% of $165,000. So that's where we get the $41,250. 25% or 1/4 of $165,000. So the value of my equity investment goes up because the investee had income. At the same time, the value goes up. That's when I record my investment income. So investment income coincides to the investee's income. I could have had an investment loss if the investee had had a loss. So again, income if the investee has income, loss if the investee has a loss. And again, it's proportional. So if I'm entitled to 1/4 of the income, I take their net income and I multiply it by 1/4. If let's say I owned 30%, well then I'd multiply net income by 30%. So it's whatever my proportion is, that's what I need to proportionally record as income. Now the dividend payment. So the investee's retained earnings decrease with the dividend, but the investor receives cash. We mentioned this before, but I wanted to re-highlight it here. So the value of the investment goes down by the amount of the dividend, but of course we're going to receive that amount in cash. So the investor essentially is exchanging one asset, the equity investment, for another asset, cash. So there's no income. It's just a changing of assets. It'd be like collecting on a receivable. You're just changing out one asset for another asset. There's no income. And so in this case, the dividend is 25 cents per share. I own 100,000 shares. And so I'm going to receive $25,000 cash. That's a debit. The equity investment goes down by the same amount, $25,000. Again, the equity investment represents my proportional ownership in that company. And so my proportional ownership reflects a decrease of $25,000. Again, the whole idea here is in total, the company paid, the investee paid a $100,000 dividend. I'm entitled to 1/4 of that. And so the value of my investment, change of the value of my investment reflects that proportion. Only the shares that I own. Again, this is usually something that students at first really struggle to understand. And like in class, usually I get a lot of questions about, okay, can you do that again? Can you whatever it is. But obviously with this being a live stream, it's a little bit different. I don't have quite the same interaction. But I also know that you can go back and look at all of this again. Again, the focus here is the change of the equity investment coincides with changes to the investee's retained earnings. That's the key. You always have to be thinking about the investee's retained earnings. Last few concepts, impairments. If a company concludes that an asset's fair value has permanently fallen below the carrying value, in other words, it's got to be permanent, that's when you're going to do an impairment. So this is really applicable to held-to-maturity securities because you remember that's always held at its amortized cost where there's no fair value adjustment. But let's say something happened where the default risk went through the roof and the fair value had dropped to like $100 par value instead of $1,000. Then at that point in time, it would make sense to do an impairment. But again, impairments are not a common occurrence, and especially not common when you do fair value adjustments anyway. Again, for a majority of other securities, the fair value adjustment would have captured this. Transfers, basically if you want to reclassify an investment, basically you can transfer securities from one category to another. So you could have it as held to maturity and you could transfer it to a trading security if you want to, or vice versa, whatever you want to do. So generally here's how you do that. First of all, you remove the security as if it had been sold. So you act almost as if it were sold. What does that mean? It means you take the amortized cost off for the debt securities, whatever it was on your books, or of obviously a cost basis for the equity securities. And then you have any fair value adjustment that would need to come off. So if there's a fair value adjustment account balance, all that stuff needs to. If there's an unrealized holding gain or loss - equity account for available for sale securities, that also would have to come off. So in other words, you're acting like you sold it. So you take the debt securities off or the equity securities off. You take fair value adjustment account balances off. You take unrealized holding gains or loss off. So in other words, all that stuff, you have to remove the security as if it had been sold. But of course, there's no cash on the other end of this, right? So that's the only difference. There's no cash. So then you record the security under whatever the new category is at its new fair value. So you reevaluate the fair value, you bring it back onto the books at whatever that fair value is. If there's a difference between the two, you have an unrealized gain or loss. And that one is going to be reported as part of net income. Again, just knowing this in theory is all you really need to do. We're not going to have an actual problem. And that is it. Like I said, I didn't think it would take, actually it only took us like 30 minutes. So it was actually much, much, much faster. But again, the equity securities piece, much shorter, much easier. I think the hardest part with equity securities is the equity method. And so just make sure you take your time to go through that and do your best to understand it. Again, you can go over the slide as many times as you need to. And if that doesn't help you, of course, you can come to office hours. I've scheduled office hours for Thursday. We can go over it then. Also, you do have the opportunity to have an individual appointment on Friday. I think there are still slots left. And if none of that works, you can obviously just email me. But if there are no questions, I'm going to be getting ready to end the stream here. I'll give it another few minutes. Or a few seconds. I get impatient. Okay, everyone. Well, thank you for hanging in there. And I will see you all tomorrow. Tomorrow's live stream will be much shorter. Chapter 18, it does not take as much time. So that'll be a much easier live stream to hang in there on. All right. Take care, everybody.